Today, the negative interest rate bus trundles on. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and property news with a distinctively Australian flavour. Well, you might be surprised to find that despite the expectations now of rising interest rates ahead, as I covered in my earlier post today, APRA is still worrying about preparedness for zero and negative interest rates. And in fact, it might not be as far-fetched as you think, bearing in mind that the latest forecasts, unofficial ones, from the Fed in the US is for a slowing GDP, and of course GDP in China is also coming off the boil dramatically. And it may well be that around the world the expectation of a strong bounce post-COVID is actually turning into a bit of a damp squib. If that is the case, then rates will need to go even lower, and that takes us into negative interest rate territory. And I still think there is a significant chance in Australia, ultimately, we may have to go there. Let's hope not, but it's certainly conceivable. And in the light of that, APRA has been doing some work in the background on preparedness for zero or negative interest rates. And in fact, they've written again to ADIs today and have tried to spell out what their expectations are. They start by saying that the Reserve Bank of Australia has stated that a negative cash rate is highly unlikely in Australia. This, however, does not preclude the possibility of a negative cash rate in the future or of other interest rates determined in the financial markets falling to or below zero. The Prudential Standard CPS 220 requires an ADI to maintain a risk management framework to manage material risks. APRA considers the risks arising from an ADI's lack of preparedness for zero and negative interest rates to be material, because that could have significant implications for an ADI's operations. So, back on the 12th of July, APRA released for consultation its draft expectations regarding ADI's preparedness for zero and negative interest rates. The draft expectations were that ADIs at a minimum should develop tactical solutions to implement zero and negative interest market rates and cash rates by the 30th of April 2022. The scope of APRA's draft expectations extended to all products and activities except for lending products that do not reference the cash rate or a market rate, including business lending, residential mortgages, personal loans and credit cards. Submissions were received from a number of organisations regarding their proposals. In fact, they received 12 from ADIs and 2 from industry bodies. The ADIs indicated that they were in fact well positioned to deal with zero or negative interest rates by mid-2022, with submissions commenting on 4 aspects of APRA's draft expectations. In the first case, in relation to deposit products, some submissions noted that implementing negative interest rates or fees on a large number of deposits through tactical solutions would increase operational risk. Some ADIs also requested an extension to the date proposed by APRA for developing tactical solutions. Thirdly, that APRA was requested to clarify that it only expected ADIs to prepare for negative interest rates on products where they would make a commercial decision to implement such rates. And finally, ADIs also requested clarity on the use of interest rate floors in lending products and additional guidance on the level of preparedness expected by APRA. And a number of submissions noted that negative interest or additional fees would not be consistent with the definition of basic deposit products in the Corporations Act 2001, and queried whether ADIs needed to be prepared for the additional obligations that would apply as a result of this. So now APRA's come up with some final expectations, and they said, consistent with APRA's draft expectations, APRA expects ADIs to at a minimum develop tactical solutions to implement zero and negative market interest rates and cash rates. But APRA made 2 changes to the draft expectations to account for the comments they received. Firstly, customer accounts, including those of related parties, with an aggregate deposit balance of less than $10 million have been excluded from the scope of APRA's expectations, noting industry feedback that tactical solutions would increase operational risk due to the large numbers of customers involved. And secondly, APRA has extended the timeframe for development of tactical solutions to the 31st of July 2022, recognising the low likelihood of widespread negative interest rates in the near term. In addressing the other comments, APRA also noted the following. APRA recognised that ADIs may make a commercial decision not to implement zero and negative interest rates on certain products that are in scope for APRA's expectations, but APRA expects ADIs to prepare for zero and negative rates on all products and activities that are in scope, given APRA's objective is to facilitate consistency in preparedness across the industry. Interest rate floors on lending products that reference the cash rate or a market rate are an acceptable solution. However, given the higher likelihood of negative interest rates on deposits of $10 million or more, APRA expects ADI's preparations to extend beyond the use of zero interest rate floors on such deposits. In developing tactical solutions, APRA expects ADIs to pre-position themselves by the 31st of July 2022 in all relevant aspects of the products and activities that are in scope, including customer communications and disclosures. As a result of a deposit product no longer qualifying as a basic deposit product, additional requirements administered by ASIC may apply under the Corporations Act 2001. An ADI affected by this should pre-position itself to ensure compliance with the additional requirements. And following the developments of tactical solutions by the 31st of July 2022, APRA expects ADIs to be able to implement the solutions within 3 months if required. So where does that leave us? Well, it leaves us with this interesting conundrum that we're in the situation where banks are still being asked to prepare for negative interest rates, which may or may not arrive, and that they should do so by the middle of next year. Now, those exclusions mean that large deposits in particular will be the ones being targeted, so that's really not consumer land, it's more corporate land. But I think there's a lot of complexity here below the surface, and to my mind, it does again alert us to the possibility that negative interest rates, or worse, could come if that turned out to be the only solution available to the regulators and to the RBA to try and kickstart the economy further, if in fact the bounce post-COVID is as weak as it could be in other countries. This ain't over till it is over. And so, as I say, the negative interest rate trolleybus trundles on. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.